You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple.
Today, we're diving into the world of investing through the eyes of one of the greatest investors of all time, Warren Buffett. Let's break down the key principles he follows, which can help you make smarter, more informed investment decisions. Warren Buffett's investing journey started when he was just 11 years old. He dabbled with stock market strategies, experimenting with things like timing stocks and chart patterns. It was fun but not profitable. But by 19, he had devoured all the investment books in the library and was still searching for the key to success. Then in 1949, he came across The Intelligent Investor by Benjamin Graham, which totally transformed his approach. There were only a few key lessons from that book that changed everything for Buffett. And today we'll focus on 3 essential principles that formed the foundation of his investment philosophy. The first lesson: a stock is not just a ticker symbol. It represents a piece of a business. Instead of thinking about stocks as numbers, Buffett started to evaluate companies as actual businesses. What's the management like? What's the competitive advantage? What makes the business stand out? In his younger years, Buffett knew the ticker symbols of every company, but he didn't understand what those companies actually did. After reading Graham, he realized investing isn't about guessing stock movements, but valuing the business itself. So, before you buy a stock, think about what business you're really investing in. Next, we have the concept of Mr. Market. Imagine having a business partner named Mr. Market, who gives you daily offers to buy or sell your shares at random prices. Some days he's overly optimistic, other days he's depressed. Most people react emotionally to these swings, buying when prices go up and selling when they go down. But Buffett teaches us to ignore Mr. Market's mood swings. If the market offers a good deal, take advantage of it. If not, just wait for the right opportunity. This helps you avoid knee-jerk reactions to market volatility. Finally, the margin of safety is crucial. Think of it like driving across a bridge with a weight limit. You wouldn't drive a truck that weighs 9,800 pounds on a bridge with a 10,000 pound limit, would you? Similarly, in investing, you want to give yourself a cushion. The company's value should be much higher than the price you pay for it. With these 3 lessons, understanding the business behind the stock, ignoring market emotions, and ensuring a margin of safety, you're on your way to a successful investing journey. Buffett also emphasizes buying companies with enduring competitive advantages, or moats. Just like a castle needs a moat to defend itself from invaders, a company needs a strong advantage to fend off competition. This could be something like a brand reputation, think Coca-Cola, or patent protection. And don't forget the management. The best businesses are the ones where the management is not just skilled, but also honest and trustworthy. So, if you're interested in diving deeper into Buffett's strategies, I highly recommend watching his video for more insights straight from the source.